Crypto ETFs, cryptocurrencies like Bitcoin, Dogecoin, Cardano, etc. are pretty awesome. Exchange-traded funds, more commonly known as ETFs, are even more awesomemer. Is it possible to combine two awesome things and make something so unbelievably awesome that it transcends space and time? Probably. But should we do it? Most definitely. We're going to talk about two of the greatest things since sliced bread in the personal finance world, cryptocurrencies and ETFs, and how they can be combined for maximum financial gains. So lovingly, tenderly, gently, smash that like button for the YouTube algorithm and subscribe to this channel. And let's get started. You're watching Finance Squared, and I'm your host, Derek West. On Finance Squared, we love talking about all things personal finance, including investments, credit, debt, and of course, cryptocurrencies. And it is pretty awesome when we can combine two of our favorite topics, that is, cryptocurrencies and ETFs. And just in case you've been living on a rock for the last 5 years, I'm going to explain to you what cryptocurrencies are. And when I say a rock, I mean like a stone on the ground, not the country in the Middle East, but cryptocurrencies have been taking the financial world by storm. Coins like Bitcoin, the most popular cryptocurrency, have been surging in value to unheralded levels. Bitcoin is currently clocking in at close to $60,000 per coin as we speak. Others have been riding that wave as well. In fact, there are many coins out there, and most of them are continuing to just go up and up as people realize that the future for these coins is really bright. They are a great way to hedge against the inflation of the US dollar and other currency, and to help to organize your finances, as the premise of some cryptocurrencies is to literally be smart contracts. In other words, automated money that does what you program it to do. But that is one of the problems with these cryptocurrencies. There are just so many of them all over the place, and if you're not tech savvy and you just want to ride the wave of popularity of this new form of currency and this new instrument for finance without having to know all about the inner workings and the inner guts of it, for example, like what the heck a blockchain is and how on earth proof of work differs from proof of stake and why that matters with the cryptocurrency you're buying. Well, in all honesty, there is no way to do that currently. If you live in the United States, that is. This problem was faced and solved many decades ago using a couple of simple products. Those products all evolved into something that we're all relatively familiar with, ETFs. ETFs, you say? Intrigued you are. On I will go. ETFs are baskets of stocks that are indexed with symbols to be traded intraday, just like stocks. That is the simplest definition out there. But to understand what an ETF is, you need to know the history behind all the products that help to bring it about. The short version of the story is, back in the day, people noticed that, hey, even though individual stocks can and do go to zero all the time, the general value of the stock market is always going up. And even some industries in general just keep going up. Even after multi-year bear markets, the stock market continues to grow more and more and more valuable. A lot of folks wish that they simply had enough time and money to buy the whole stock market instead of just buying individual stocks. At the time, back in the day, there were and are such things as mutual funds and hedge funds. Those funds were companies that people put money into. The money that you put in would then be invested in a basket of stocks. This basket of stocks would be watched over by money managers, who would then try and beat the market with their stock picks, which meant to them to avoid the biggest losers and try and pick the biggest winners, leave everything else mostly alone, and voila, you have a profitable fund. The problem is that very few people can beat the average return of the stock market. And all the mutual funds that people are buying into, they rarely ever outperform said market. Some of the funds do, obviously, but a surprisingly small amount, and most do not. And that's when in 1979, a man named Jack Bogle came up with the idea for a mutual fund that simply tracked the larger stock market. No need to try and beat it, just try and match it. And the way that you can do that is to buy every single company in that index, and thus the index fund was born. The long version of the history is much more complex, as I'm sure you know, but this video isn't supposed to take all day, and that's just the Cliff Notes version. But ETFs and index funds are similar, but different at the same time. You know, kind of like how panda bears are like bears, but they're not really bears, like say polar bears are. Yeah, that is how I would describe the relationships between ETFs and index funds. Not quite polar bears. State Street Global Investors launched what many people consider the first ETF in 1993. Barclays followed in 1996, and Vanguard, the company that Jack Bogle launched his index fund with, launched its own ETF in 2001. ETFs, or as they're known in the nerd world, exchange-traded funds, are baskets of stocks. They differ from index funds in that they are traded on an exchange and can be bought and sold like a stock, whereas an index fund are mostly executed like mutual funds that instead of purchasing stocks to beat the market and are actively managed, they just purchase every stock in an index like the S&P 500. Now, wouldn't it be awesome if you could invest in the whole of the cryptocurrency market via an ETF that is simple to purchase on a day-to-day basis? Actually, yes, that would be very awesome. Canada recently allowed and legalized the creation of cryptocurrency ETFs. The US and other countries are not quite there yet in terms of their regulations, but recent appointments to the SEC seem to indicate that maybe the US is on the verge of also allowing for cryptocurrency ETFs, which would again be awesome, and for several reasons actually. The first being lower compliance risk. This is not to say that an ETF product will magically reduce price volatility or other types of investment risk, but it could certainly reduce some of the record keeping and reporting issues. Having an investment option that is both familiar to investors and registered with the powers that be does reduce some of the risk, making it that much easier for your average retail investor to comfortably invest in the product. Another great reason would be simplification of crypto storage. One issue that continues to cause crypto adoption in the wider cryptocurrency marketplace to be sort of slow is the question of wallet management, or how investors would actually hold and store cryptocurrency. In case you've never owned a cryptocurrency before, basically you don't really own a cryptocurrency unless you have the private keys to the wallet, which is one of the things that makes cryptocurrency not really consumer friendly. As I'm sure you can imagine, a significant number of investors most likely do not want to have to actively manage crypto wallets, keys, and other crypto specific information. It's just too crypto nerdy. It is a shame, but it is what it is. Enabling crypto ETFs would allow for you to let all that key management and wallet management be under the control of the ETF that's holding the cryptos for you, effectively simplifying the whole venture. Another great reason would be that it would allow for fractional investing potential. An underappreciated aspect for why mobile investing is so popular nowadays is the fact that these apps, such as Robinhood and Webull, well, these apps allow for fractional investing with low premiums, fees associated with this option. Fractional investing in equity securities enables your small-time retail investor to start building his wealth without having to save up to buy the whole thing at the time that they want to buy it. And the low fees to do this help to expand the reach of buying stocks to just about everyone. This practice is akin to putting stocks on layaway, except you get the benefit of the stock or other equity rising in value. On the flip side, you also get the detriment if the stock falls in value. But with cryptocurrencies, specifically Bitcoin, trading in the tens of thousands of dollars, that in and of itself restricts the market and the ability of investors to participate therein. ETFs allow investors across all economic levels to gain exposure to investments that might otherwise, if we're being honest, be unattainable by your typical retail investor. There are many other reasons as well for having crypto ETFs, including the merging of the crypto world into the regular world. Even with all the heights that crypto has achieved recently, it is still relatively low volume when compared to other investment types. Creating crypto ETFs would significantly bridge that gap. Now, are there any downsides to allowing for crypto ETFs? Well, as regular watchers of this channel can attest, there are downsides to just about every good thing. Life is full of pluses and minuses. The goal is to compound the pluses and minimize the minuses. That said, yeah, there are some downsides to having crypto ETFs. Blow that bubble up more, why don't you? Regular watchers of my channel know that I think that cryptocurrency is in a massive bubble right now. Now, I reserve the right to be wrong on that, but it has all the classic signs of a market bubble. People are buying crypto and not understanding what it is that they're buying. People think that it will continue to go up and up and up with no real reason. Some folks are purchasing cryptocurrency like they are a type of stock, when most cryptocurrencies don't really offer a product or a service to anyone, but is in reality promising to be a currency or a smart contract. And on top of that, owning said cryptocurrency doesn't necessarily give you ownership in the cryptocurrency company that's creating that cryptocurrency. It's just really giving you the token. When people realize those basic facts and understand what it is they are actually buying, my opinion is there's going to be a massive correction. But following that, cryptocurrencies are going to be just fine, as people will have a better understanding of what the value proposition is and what they are purchasing, and they'll also have a better expectation from their purchase. Now, of course, I reserve the right to be wrong. People might already understand what they are buying, and crypto might be priced just right. But certainly, allowing crypto ETFs will be pumping more hot air into that crypto balloon, if I may paint that picture. Another downside of crypto ETFs would be the extra regulatory scrutiny that may actually force cryptocurrencies into a place where people would not like them to go, basically making them more restrictive and more centralized than what cryptocurrency enthusiasts envision them to be, effectively making them more like the fiat currencies that they're trying to improve. Something that people should try to improve is their access to high quality, entertaining, yet informative videos on all topics related to personal finance. Improve your access by subscribing to this channel and turning on post notifications so you don't miss out on any of our videos when they drop. Also, make sure to like this video if you liked this video, and drop a comment with your thoughts on cryptocurrency ETFs. Are they a good idea? Are they a bad idea? Something that the US should really try and implement, or something that the US should try to avoid? And why you got all these things going on in your head? Remember, A goal without a plan is a wish. A goal with a plan and no action is a wish list. Take action on your personal finance journey by getting into ETFs and cryptocurrencies so you'll be prepared if and when cryptocurrency ETFs are legal where you live. And I'll catch you next time, folks. Peace.